what has set you apart for me in the last couple of months is your willingness to say the recession playbook is still intact and there's nothing different about coming out of this contraction compared to all the other contractions. Mike, would that be a fair characterization?
Yeah, thanks, guys, for having me. And yeah, I think that's a very fair sort of, way we've positioned ourselves, which is essentially, look, you have to put the blinders on a little bit when you go into a recession from a financial market standpoint, because markets tend to anticipate these things. And, we've been talking about this setup for over a year or two, and I think that's probably what set us apart, too, is I came into this year kind of more negative than most, expecting the risk of a recession being higher. So then when it happened, the market was actually already ready for that, and then we had a liquidation in March. And the other thing that's different this time, though, I think, is that we are in this incredible period of financial repression, and that's obvious. And the one thing I've learned kind of the hard way in the last 10 years is that when risk premium appears, you just have to grab it, and that appeared in March. We've written about this extensively. As you know, on an equity risk premium basis, we were as cheap in March as we were in March of '09. And you may say, well, how could that be? We weren't down as much. Well, because rates had fallen so much. And so markets have become, attuned to that, and they reacted, and investors stepped in, and that's what we've been doing. And yes, the recession playbook has been working as it typically does during these periods.
Mike, many people anticipate the bounce that we're seeing in the economic data to flatten out later this summer. And for that reason, they're not willing to extrapolate out the recent upside surprises too far, too quickly. In fact, some people willing to disregard the bounce that we're seeing coming into the month of June. What do you say to those people when you have those conversations at the moment?
Well, look, you said at the top of the show, part of the reason why economic surprises are bouncing so much is because expectations, collapsed. And that's also part of our view. You're getting a V-shaped recovery because your comparisons are just so easy. And, of course, it's going to have to flatten out now because, look, every time the data comes out better, expectations rise. So the bar essentially gets lifted as well. So it will flatten out, but we still think the rate of change will continue to be positive through the rest of this year, quite frankly. And we're not expecting us to be back to where we were in the fourth quarter of 19 until the end of next year. In other words, there's still a lot of runway from here to there for the rate of change to continue to increase. And that's what the markets will focus on. The markets will focus on, as long as growth is moving forward, the market will continue to look forward. And, it's really hard to think about it this way, but, we're actually in a recession now that's obvious. That means I don't have to worry about a recession, okay? That means the market doesn't have to worry about a recession like it was perhaps in December and January, not knowing how this is going to play out. Well, we know how it's going to play out now. It's happening, and we know what the policy response is going to be. And so in some ways, you could argue, given that stocks are long-duration assets and you've removed the immediate risk of a recession surprising us, it can actually start discounting the future in a more visible way.
Mike, how do we rotate in such an unusual and particularly with the fixed income market, odd market? How do we rotate from 7 or 8 stocks showing, for the most part, profitability, and everybody loves them in that, to those that are at a 12 multiple, a 15 multiple, dare I say, the richness of a 17 multiple? What will be the catalyst to have those stocks improve on a relative basis?
Yeah, that's the right question, and it's a great question. I think it's very simple. My experience has been that when the relative earnings revision breadth starts to favor those cheaper companies, meaning the earnings start going up at a faster rate for those more cyclically geared companies than these wonderful secular growers. And you may say, well, how could that possibly happen? Well, because the earnings were so lousy over the last year or two that they can actually grow faster in the short term. So and the expectations have come down more. One of the things I worry a little bit about the work from home beneficiaries that did really well in the early part of this recovery is that they didn't really lower their expectations. The analysts continued to keep their expectations high. So there's not as much surprise factor potentially as the economy continues to recover, and there could be a little bit of payback, quite frankly, from the pull forward on the work from home dynamic.
Mike, I got to say, one reason why I love reading your reports is your view on the short term paired with the medium and long term, talking about last week's sell-off, saying it was healthy, overdue. It could be even due for another 5 to 7% decline in addition, but it's a buy the dip moment. I want to talk about the risks to that outlook, one of them being the potential increase in trade tensions between the U.S. and China, especially as we see Robert Lighthizer heading to Congress today. How significantly do tensions have to ratchet up for you to reassess your call?
Yeah, I mean, this is definitely still a concern that's out there. I think, you all mentioned it earlier, the market doesn't seem to be too focused on it anymore. I think the market is focused on it. It's got so many things to focus on from day to day. So there's no doubt that the China, U.S. trade relations are still, fragile. I'd put it that way. And we have far from resolved all of the issues that have been debated. And I think a phase 2 trade deal is pretty much off the table anytime soon. And I guess the risk now is, do we roll back the phase 1 trade deal to some degree? Look, our view is that we think phase 1 is okay for now. It's not at risk. However, if this becomes a situation where either candidate, particularly the president, can use to try and bolster their poll numbers, that's where it becomes a bigger risk, and that's probably a third quarter issue. I don't think it's an issue right now. There's other things that the White House is focused on to try and get going in the right direction. But if they decide to use it as a lever to bolster the polls, that's where it becomes more dangerous because once you go down that path and start saber rattling again, it's hard to pull back in. So I think it's a third quarter issue, and we got to monitor it closely.
Yeah. Mike Wilson, one of your joys is the fabulously concise reports of Betsy Graseck. You get to read that stuff and frame an opinion of the too big to fail banks. What's the Mike Wilson view of American banking, given what you see from Ms. Graseck?
Yeah, look, banking has been a tough gig for the last 10 years, and that's what, post-financial crisis and a period of financial repression has done. There's two things I think about from here. First of all, we are, constructive that the economy is going to improve, and that means the back-end rates should move up and increase the yield curve, which is good for, net interest margins, and that's potentially a positive tailwind. I think secondarily, everybody's talked about deregulation, over the last few years. It hasn't really led to any kind of big boost in activity, quite frankly. However, one thing I would say is different now is, during the post-financial crisis period, we had what we call the shadow banks in there intervening and doing their job as the regulated banking system had been kind of, compressed and not being able to operate as effectively for a lot of different reasons. There is a positive argument, I think, to be made that some of that business, there could be share gains coming back towards the regulated banking system because the Fed clearly needs the banks to be operating efficiently. If they ever want to get inflation, we got to get velocity of money up. I mean, banks are the ones who actually create, real money in the economy. And so, we could see a steeper yield curve. We could see some more deregulation and some share gains back. That's why we're constructive. And we're constructive on the American banking system having kind of a rebirth here as we get reflation and we have a recovery.